have pasted the live YouTube link here. So hi everyone. So welcome to today's live session. So today we will be doing a brief recap of week 9 and 10, and then afterwards we can take questions if you have any for the second quiz, which is scheduled tomorrow. So for tomorrow's quiz, the syllabus is from week 5 to 8. There are 25 MCQs will be there and time will be 1 hour. Correct? Okay. Am I audible?
Yes, sir.
Yes.
Okay. Thanks. So in week 9, we had an overview of the foreign exchange markets, like how exchange rate works, and then international capital markets, what are the pros and cons of that also, and how exchange rate crisis can take place. This was the agenda, like how international markets are interconnected. That was the agenda for week 9. So exchange rate, it can be defined in both ways, but for the lecture purpose, for instructor has used the definition in a way like the price of the domestic currency in terms of foreign currency. So if you take example of India and US, so if Indian rupee, like 80 Indian rupees is like the price is $1, then the exchange rate for India is 1 by 80. That was the notion we have used during the lectures. And the exchange rate defined in this way, like the 1 rupee is equal to 1 by 80 US dollars. This is called nominal exchange rate. So it is defined in terms of currencies. And similarly, what we did in our interest rates case, we can define the real exchange rates also, which defines how many goods, like the domestic goods, can be exchanged for the foreign goods. And we use this epsilon denotes the real exchange rate and E is nominal exchange rate. Then this is the formula through which we can calculate real exchange rates, where P and P star are the price level in domestic economy and P star is price level in the foreign economy. Okay. And then we discussed appreciation and depreciation, which are the common words for exchange rate. So if exchange rate rises, we call it an appreciation. If exchange rate drops, then we call it decreases, then we call it a depreciation. There are so in case of India, hello. Okay. So in if you take the example of India and US, so appreciation would be like rise in the value of rupee in terms of US dollars, and depreciation would be like the decrease in the value of rupee in terms of US dollars. So if Indian rupee, so now the exchange rate, so if we say rupee, can you please mute yourself? Uh, so now further we the using the no arbitrage condition, we go to this uncovered interest parity condition, which is a relation between domestic interest rates and foreign interest rates, which is defined by the domestic 1 plus domestic interest rate is equal to 1 plus foreign interest rates times the today's exchange rate divided by the expected exchange rate in the next period. This we call the uncovered interest parity condition, and we derived it through the no arbitrage condition. Like if I hold an asset in domestic economy and the same asset in domestic economy and same in foreign economy, there should not be an arbitrage opportunity there. Through that, we derive this condition. And from this, like we can derive an approximate relation between interest rates and exchange rate appreciation. So the last term ET plus 1 upon it, like this is the expected appreciation of the exchange rate, and IT star is the exchange rate in the foreign nation, and IT is the interest rate in the domestic nation. So this is the relation between them. So the domestic interest rate is equal to, like, approximately equal to foreign interest rate minus the expected rate of appreciation. And by doing the calculations, like by using this definition of real exchange rate and like rewriting the uncovered interest parity condition, we can come up to the interest parity condition in real terms also, where these interest rates and exchange rates are defined in the real terms. So this is the formula which we derive, and we have done some problems in our weekly assignments over these calculations. Is there any questions in like how exchange rate is defined, real and nominal exchange rates, and these interest parity conditions? If you have any doubts and concerns, please raise them. Okay. Next, in the lectures, we discussed about like what are the different exchange rate regimes. So two prominent exchange rate regimes are there. One is the fixed exchange rate regime, where the exchange rate is fixed to a constant against a nation. So for example, there are many nations who have fixed exchange rate against US dollar. And another is the flexible exchange rate. So this exchange rate is driven by the, like, it is market determined depending on demand and supply of a particular currency. So in India we use like this flexible exchange rate. So most of the nations in today's world are using this flexible exchange rate regimes, and we discuss like what are the pros and cons of these two different exchange rate regimes, and how how the going from one exchange rate regime to another can lead to an exchange rate crisis. For that, like we discussed the 1992 exchange rate, like the exchange rate mechanism crisis in euro area. So in which like the Great Britain, UK, like the adopted the euro. So there was a, they were adopted the same currency, and there was a high inflation in UK, so they like led to this ERM crisis. And also later we also discussed like what is the optimal common currency area. There we took the example of USA as well as European Union. And so US is a like, and for an optimal currency area, common currency area, it is required that they face similar kind of shocks, and there is like the very flexible mobility between various assets like the labor and capital. So that is the requirement. So which is there in the case of USA, but not in the case of EU. So that we concluded that EU is not an optimal common currency area. Next, we move to like the how international capital markets works, what are the pros and cons, and what all are other major players in international capital markets, and how it is difficult to like the regulate international capital markets. So in case of like the domestic markets, there are many regulation and safeguards which are in place, like deposit insurance or some reserve requirements or like the bailouts from the government. It's like those are there, but these are not available for the international markets. So that was the point of discussion. And later on in our lectures in week 9, we discussed about various financial crises. Like the main origin of the financial crisis is like the markets in the returns in the developed economy market is very low, so capital starts flowing from developed markets to developing markets. So there is an influx there, but the developing markets are not fully, like, not deep enough to manage this kind of funds, and then it lead to financial crisis later. So this was the agenda for our week 9 discussion. And so if you have any concerns, any doubts for week 9 content, please let me know. So in today's discussion, we will not be taking we will not be exercising examples. So in the next live session, because I want to cover few exercises on exchange rates as well as on the options which we discussed in week 10. So in week 10, we started our discussion over the derivative markets. So derivative instruments. So what is a derivative asset or derivative product? So derivative is a investment whose value is determined by the value of some other asset over which it is defined. So for example, there are several derivative products like forwards, futures, which we have not covered in this in this course, but in the week 10 we discussed about options. So what is an option? Options, like there are two types of options: call option and put option. So a call option is a derivative product, which gives its holder the right to purchase the underlying asset. So normally, if the option is defined on a stock, so it gives a right to purchase the stock at a pre-specified price, which we call the strike price or the exercise price, on or before the some specified expiration date. So for example, if you have a call option on HDFC Bank share, so which is going to expire in the expiry date is in next 3 months, and the exercise price is, let's suppose, 500 rupees. So the holder of this option have right to the purchase HDFC share at 500 rupees on or before this expiration date, within 3 months. Similarly, put option is the put option gives the right to sell that particular asset on or before expiration date at a pre-specified price. So these kind of products come with they are priced. So the price of these options is called the premium. So let's suppose this kind of derivative product. So for example, the call option on HDFC Bank, you purchase it for 6 rupees. So this 6 rupees is the premium on this call option. Okay. Now, so this is the purchasing, if you are holder when you purchase an option, but when you can also sell these options also. So when you sell the option, so it is called writing an option. So when you sell an option, so you are giving the person who is buying from you a right to purchase a particular asset on that pre-specified exercise price. So we call that a writing an option. And for options, there are, so if this option is giving me a positive cash flow on the expiration date, then it is called to be in the money. So in the money means it is giving a positive cash flow. So, and if it gives negative cash flow, then we call it out of the money. And zero cash flow, when it provides zero cash flow, then we call it at the money. So how do we define the cash flow of a option? So a call option gives the right to purchase an asset on a so we define the exercise price by X, and the asset that is stock or share in our case for our discussion. So we define that by this notation S, and expiration date by capital T is the expiration date. So if on a particular point, if the stock price is more than exercise price, so in that case a call option gives a positive cash flow. How? Because call option has given you a right to purchase on price X. So if you can purchase on a lower price, and then you can go to the market and sell it S, which is the current market price, so you can earn a profit of S minus X. So that's why there is a positive cash flow. That's why it is in the money. Similarly, in the put option case, if stock price is higher, then like you have option to sell the sell that asset. So in that case, if the stock price is higher, then your put option is out of the money because it gives you a negative cash flow, because the holder, so you have right to sell at X which is less than S, so you are incurring a loss, so that's why it is out of the money. And when stock price and the exercise prices are the same, then the net cash flow in both call and put options is zero. So that's why it is called the at the money. So there are two major types of options. So one is the European option and another is American. So European option, like it can only be exercised on the expiration date. So if expiry date is 3 months, so it can only be exercised after 3 months. The date is pre-specified. But in the case of American options, it can be exercised anytime within the expiration period. So if it is the option is going, an American option is going to expire in 3 months, then you can exercise this option anytime in this 3 month period. And we have already discussed the value of option. So for a call option, the value is like the stock price minus the exercise price, when stock price is more than exercise price, and zero otherwise because it is a right, not an obligation. So it is a right, to purchase the asset. So when you are incurring a loss, you will not exercise your call option, so your value of that option is zero otherwise. You only exercise the option when you are getting a positive payoff from the option. Similarly, in the case of put options, your payoff is like exercise price minus the stock price, when stock price is less than exercise price, and zero otherwise. When stock price is more than exercise price, you do not exercise your right to sell the asset. So that's why it is zero otherwise. And this is the value. So value of the option. So from this you can calculate the net profit also. So net profit would be like whatever the value you are getting from the option minus the premium, like which is the price you paid to like purchase this option. Any questions till now for options and etc.? Okay. Next, we discussed few trading strategies which involve options. So first strategy is protective put, in which like you purchase a share of a stock and a put option of the same, like a put option on the same stock. So what it does, it puts a bar on like the what is the maximum loss you can maximum potential loss which you can incur, but your gains are like the when stock price rises, then your gains are as high as your stock price rises. A similar strategy to that is like covered calls, in which you write a call option and purchase a stock. So this also puts a bar on your potential loss. And other strategy like which involves only the options. So one strategy like only purchasing the options, not stocks. So one such strategy is trader, in which either you purchase or sell the a call and put on a particular stock with same expiry and same strike price, that we call as trader. And similar to that is strip and strap strategies, in which in strip you purchase two puts and one call, and in strap you purchase two calls and one put, and through that you build your portfolio, and then from that like you can derive like what would be your payoff in different kind of situations. Okay, next, like by using the arbitrage conditions. So we derive a very important formula for like which we call it important condition which we call it put call parity. So which is a like the relation between call price and put price for like when they are for the same expiry and same strike price. So if the strike price of these call and put option is X and current stock price is S naught and risk free rate is RF and T is the expiry of these options, then this is the relation. So which is the like price of the call option plus the present value, like the price of the call option plus the X divided by 1 plus RF to the power expiry is will be equal to the stock price plus the put option price. So this we derive from by like the building a portfolio which gives the same, like building the portfolios which gives the same output is like these two, like the right hand side is the stock plus the put option which is the protective put, and left hand side is the call plus like this is X, so this is like I think borrowing if I'm correct. So this is like borrowing X, so like lending X, lending some amount, lending X amount which gives like X upon 1 plus RF to the power T in later period. I think something like that you can see the lectures. So this is the put call parities. Like if you have a information about a call option with these like the T expiry date, X exercise price, S stock price, then you can get the value of like the similar put option. You can derive the value of that put option using this put call parity condition. So we will be doing some exercises in our next live session. So now I open the floor for questions if you have any for your quiz, and for like week 5 to 8 we can like we can solve them here. We can, you can raise them here.
Okay, my Srinivasan here. My question is, after reading week 7 and 8, right,
Yes.
there are quite a few formulae. Of course, now it is not a fair question because I don't want you to out the questions, but do we have to remember all the formulae, or is there a subset that we should focus on?
Yes, formulas are very difficult, but you need not to like they remember all the formulas, but you should be aware like how you get to those formulas. Like when you do portfolio, like when there are two risky assets, when you want to derive the minimum variance portfolio, what you do, you like they minimize the variance subject to your various constraints, correct? Like the weight should, sum of weight should be equal to 1 and something like that. So you should be able to solve that mathematical problem, that minimization problem. So that is the part. You do not need to remember the final formula which you get there, because in exam you will be given like the values of like R1 bar, R, like the expected rate of return on these assets and their standard deviations, and then you will be asked to find that. So then you will get simple equations if you solve that. So you should grasp the method, not memorize the formulas. That is the key, which I would say.
But then are you saying that when we get a problem, we actually start from the sigma square equation, derive that, and then apply the numbers?
No, not start like directly put in the values for the sigmas, and like then you will get a simpler expression there. So for example, for example, like as we solved in our last live session also. So if you are given only two assets, then your then your problem becomes only like in one variable. So you get your variance in only terms of weight of one asset will be W and other will be 1 minus W. And through that you get only a like the functional form of in only in terms of W, and then you need to minimize that. So you simply do the first order differentiation and equate equal to 0, and then you get the value of W. So this is how you can solve this type of questions. So if you want, like we can do a such type of like the problems here also.
No, that actually, I mean, I'm kind of familiar with the problem, just worried about the amount of things that I have to memorize. Yeah, I'll use the principles part, then hopefully that would help.
Yes, that would be good for you. Like if you, like my idea is to not memorize the formulas, but like try to like practice like how you get to that formula. That is the important part. Like, so in lecture also, like later in where we solve the examples, there we solve some problems. So in exam, like the problems will be of that kind of only, like not too harsh calculations there, but simpler calculations. And focus on the concepts, like concepts of efficient frontiers and like the capital allocation line, how you get to the like the optimal risky portfolio, and optimal capital allocation, how you derive that. Like these concepts are more important, because we know that like if you know the concept, then it is easily solvable. Any other questions if you have for your quiz and all? Yes, Abhinit, we will be covering week 10 again in our next live session.
Thank you, sir.
Yeah. And we will also be doing exchange rate like numericals in our next live class also, like some questions of that.
Like in the exam, if I'm going to stuck, it is only the question of weight equations.
Sorry?
If I'm going to be stuck in the examination, it is because of the weight equations that is different variants.
Weight equations
Like first
in
weight
two
was
ways.
given in the first weight was given in the week 7 for the two assets, and then in week 8 we again come with the two asset, but different things. First was the risk free and risky asset with the SAP ratio thing, and second uh, with the risk free and risky asset, but in the condition that both are negatively two risky assets, but both are negatively correlated. That specific
Yes.
situation, and then weight condition with two risky assets. Uh,
Hmm.
that is exactly in using like a rate of return, both rate of return using that formula, and then the optimal portfolio management, optimal risky portfolio. Weight equation of that.
Yes.
So
So,
it
so what about like you want those formulas to be given upfront to you?
no, say the formula has already been there in the what is it in the examine in the
In the
slides.
lectures, in the slides?
Also,
Yes.
the when we derive the utility function, converting them into SAP ratio, and then with the sigma and weight, we can derive the formula for the optimal risky portfolio for two risky asset with one risk-free asset. Also, similarly for minimum variance, I can do that.
Yes.
Even the first one, I can do that.
Yes. Yes. So we did a recap of our like from week 5 to 8 in our last live session. So the like the lecture notes have been uploaded in our live section Google Drive link, and you can look at them. So that will give you a like the overall recap of what we have covered in last these 4 weeks. So only like that part will be they asked in our like the second quiz. So in like we have taken a note of like from your quiz one experience, like in this quiz there will not be any like lengthy or large numbers will not be there. So I think all the there will be some questions where you will need like you will need the calculators, but most of the question will be like in such a like you can be solved with pen and paper only, not calculator required.
Thank you, sir.
Yeah. If you have any other questions or like the concerns regarding week 5 to 8, you can raise them here, or you can post them in our Google discussion forum also. And we will be meeting next week for our continuing our discussion regarding like the derivatives, like pricing of that, etc., etc. And all the best to all of you for your tomorrow's exam.
Thank you. Just a curious question. So we will have week 12 also, right? We will have all 12 weeks content.
Yes, yes. Yeah, we will have all 12 weeks.
And the end term, would it be week 9 to 12?
Yeah, mostly like from week 9 to 12, but yeah, there will be like few questions from earlier weeks also. Like there will be very less weightage to them, but yeah, there will be few questions there.
Okay, thank you.
So that like the proportion, like I will let you know like once I meet the instructor, then I will let you know like what will be the proportion of in the final exam. So final exam is for 1.5 hour, if I am correct.
Yes, sir.
Okay.
That's right, yeah.
Correct. Okay, then see you next week, and let me know if you have any concerns over our discussion forum and discourse forum.
Thank you. Bye then.
Yeah, thank you.
Thank you, sir.